The CFPB just put out a blog post that shows how bad the credit crisis is here in the United States of America. No one seems to be digging into the data, so I thought I'd walk you through it. The auto loan bubble is huge, and it may not be popping. I know I get a lot of slack, or people really hate that I say the bubble's popping, but it's leaking. Like, something is definitely happening. Let me show you here. Let's walk through their blog post. First things first, the prices of used and new vehicles since July of 2020, they have gone up a lot. Look at the chart. Used vehicle prices up nearly 40%, or more than 40%. Used vehicle prices up more than 20%. Where things get interesting in the CFPB data is when we start to break down credit tier. So we can see here the average amount financed by prime, near prime, subprime, and deep subprime consumers. The biggest increase proportionally is for our deep subprime borrowers. In Q1 of 2022, they were borrowing nearly $23,000, up from where they were in 2017, where it was more like $16,000. So everyone's borrowing more, but deep subprime are borrowing proportionally the most. Now, the average loan term, this is where things get scary. Those deep subprime borrowers are up to an average 65-month loan term. At like a 15% interest rate. I mean, it's truly unbelievable what's happening to that cohort of consumers. Again, the most significant increase in loan term length is amongst deep subprime borrowers. And I promise here, stick with me. There's a reason I'm harping on deep subprime. Average monthly payments, obviously, deep subprime borrowers have seen the largest increase in their average monthly payments. And here's where we start to get into delinquency rates. This chart that you're looking at, the green line, those are your deep subprime borrowers. And at first, sure, you see a big spike in the first quarter of 2022 in terms of delinquency rates, but you look historically and it's actually not particularly concerning, right? Because back in 2018, 2019, 2020, delinquency rates for deep subprime borrowers had been up 1.5%. I mean, they had been pretty high. We're not even at those levels right now. Deep subprime borrowers in early 2021 had actually seen their delinquency rates below 1%. So why am I saying, how can I in any good conscience say, hey, the bubble's popping when it's not even close to what it historically had been? When you start to look at things by vintages, this is where things get interesting. So let's explain what this chart is showing you. You have delinquency rate on your y-axis, and you have quarters since origination on your x-axis. Each color here represents a vintage. And what we are looking at is the delinquency rate over time for a particular collection or vintage of loans that had been originated. So for example, the green line here, when you get out to 8 quarters from origination, the green line shows you 8 quarters from origination for 2017 auto loans. The delinquency rate was between 0.6% and 0.8%. Of a percent, not of, 0.6 to 0.8 of a percent. If we look at the 2018 vintage, we can see that their delinquency rate was higher. It was above 0.8%. When we look at the blue line for 2019, we can see it was below 2017 and significantly below 2018. So the 2019 vintage, once it reached 8 quarters of maturation, had seen delinquency rates lower. 2020 was even below that. And now look at 2021, the purple line. By 6 quarters, so from 6 quarters from origination, 2021 has a higher delinquency rate than any of the previous vintages had at that period of time. It's actually 13% higher than any of the previous vintages. And it's very, very small down here at the bottom, but 2022 in gray is already 2 quarters in experiencing a higher level of delinquency than any other vintage had, including 2021 loans that were originated. So already the 2022 vintage is already performing worse than prior vintages. Okay, so kind of interesting. We're starting to see, maybe more recently originated loans are actually going delinquent more frequently than prior loans or previous vintages. This becomes much more pronounced, and kudos to the CFPB for publishing this data, but shame on everyone for not talking about it. When you start to look at deep subprime and subprime loans, let's focus on deep subprime. In 2017, 8 quarters out, it was between 5 and 6% of deep subprime loans ended up delinquent. 2018, pretty much the same. 2019, it was below 5%. 2020, it was about 6%. 2021 is already performing worse than any prior vintage. And look at 2022, the gray line. We are 2 quarters in And we have never seen delinquencies as high as they are, as quickly as they are. And kudos to you, CFPB, you wrote it out right here. Quote, this trend is even more pronounced for consumers with subprime and deep subprime credit scores. For example, 2022 vintage auto loans for consumers with deep subprime credit scores were 2.4% delinquent 2 quarters after origination. That is wild, which is a 33% increase from the previous 5-year high set in 2020. We are 33% higher than the previous record. This is making me nervous. It's making the banks that made those loans nervous. We've talked about on this channel many times before CECL reserves, essentially the amount of money that financial institutions set aside for likely delinquent loans that they're not going to get paid on. We've seen all sorts of financial institutions set aside more and more money for CECL reserves. Everyone knows this. Everyone on the inside knows this, that these deep subprime borrowers, and it's happening in subprime as well, those borrowers are not going to pay these car loans off. They got super extended terms. They went way over their skis. We are going to see an incredible increase in delinquencies and ultimately repossessions of those vehicles. Buying a car? Let the team at YAA help. Use the code FALL20 and save 20% on a YAA membership, or use FALL100 and save $100 on an extended warranty. Now, at the same time that on the loan and on the financing side, we are seeing the increase in delinquencies and repossessions amongst deep subprime and subprime borrowers, we are also seeing the value of those vehicles that they had previously financed decrease. Like, they are boat anchors. People who bought used cars 6 months ago, and the time this video comes out is September of 2022, people that bought used cars within like the past year, they bought at an incredibly inflated price. And that means that they had financing at an incredibly inflated price. We saw lending restrictions that were non-existent. It was very easy to get access to credit and well above 100% of what the book value was. So people were financing 125, 130, 140, 150% of what the vehicle was actually worth, because vehicle values were just through the roof. Used car prices were through the roof. And we are now, and this data comes from Black Book, and also Cox Automotive has Manheim, we are seeing each week about a 1% decline for the past 2 months now, a 1% decline in wholesale used car prices. So let that sink in for a second, because wholesale used car prices are what the banks are using to value their collateral. Well, each week it's dropping about a percentage point. So imagine you took out a $40,000 loan as a consumer on a car that, when you bought it was a $40,000 car, that now at the wholesale auction is a $36,000 car. The bank's not liking the math on that, and neither should you. Why do you think we're going to see more delinquencies and more repossessions? Because people are just going to stop paying. It's I was young back in 08, 09, but why would I pay for something that's not, it's not worth as much as I got the financing for? So while we're seeing loan delinquency rates go up, and ultimately that will lead to repossessions go up, we are also seeing used car prices go down. Wholesale used car prices, I should say. Retail used car prices are just starting to soften. We have now a 10% increase in the amount of retail listings, used car listings on the market. That's huge. That means there is more supply than there is demand. That supply will likely increase as well because of 2 factors. One is new car production is not fixed, but we are seeing rental car companies finally start to pull away from the wholesale auctions, and they're getting some fleet sales from manufacturers. And the other reason supply will go up, so one is rental car companies aren't gobbling it up like they were last year. The other is all those repossessed vehicles are going to go to auction. It might not happen all at the same time. The banks are going to be, I think, relatively smart about sending vehicles to auction. They don't essentially want to like margin call all of those vehicles and lose a ton of money. So they're going to kind of trickle it out, would be my expectation. But you will see an increase in repossessed vehicles, which you also need to be a little wary. I always screw up weary and wary. You just need to be careful if you're going to buy a used vehicle in general, especially if it was a repossessed vehicle. Now, the final thing that I'll bring up here is that the financial institutions are not only getting concerned about consumer financing, they are also concerned about the inventory that their dealers are carrying, because each week it is losing about 1% of its value. And dealerships do not pay cash for their inventory. They pay financing, or they don't pay financing, They finance their vehicles and pay floor planning or interest expense on those vehicles. Car Dealership Guy, great Twitter account. Highly encourage you to follow him or her. Who knows? Well, no, it's Car Dealership Guy. Follow him. Look at this thread of tweets. This was from September 17th. At least, 2 major auto lenders have started aggressively purging dealer partners for the past 2 weeks. Here's what no one is talking about. Over the past 2 to 3 years, the car business has been so strong that dealer loan portfolios were buoyed by large volumes of new originations, but now the party's over. Dealers are no longer originating new loans at record volumes, leaving the older loans to, quote, fend for themselves. Naturally, this is starting to create dispersion in dealer loan performance. For the fourth tweet, you'd think purging dealers is a common practice, right? Wrong. It typically only happens when a small subset of underperformers, Bottom line, lenders are tightening fast. Ultimately, what you're looking at here is that the paper, and we talked about this with a video we did with Lucky Lopez, great channel, Lucky's channel as well for information on this. The paper, the bundling of the loans that these dealerships have financed, or the financing companies have financed, they're trading it. They're trying to get their hands off of it. They're purging their books. They are selling for less than what it's actually worth. Imagine a loan is worth $1 at when it's called. They're selling it for 95 cents. They want to get rid of that loan. They want to sell it to a hedge fund, a pension fund, anyone else who will take on the risk of that loan actually coming to fruition, because they don't like what they're seeing. And so when you look at this, no matter how you slice it, you'll probably mock me for calling it bubble bursting. I don't know what else to say. I mean, it is. Like, look at the delinquency rates. Look at the pressure that's being put on dealers. Look at the pressure that's being put on wholesale used car prices. It will translate to retail prices. Like, you do not have a choice if you're a dealer sitting on a used car. Like, you're either going to sell it for a significant loss and take a bath at the auction, or you're going to negotiate with a retail customer. So that's the lay of the land. That's the auto loan apocalypse, repo-apocalypse, the bubble party, whatever. That's the update. That's the data from CFPB, Black Book, Cox Automotive, Manheim, and an anonymous Twitter account. I don't know. It's 2022 on YouTube. Like, that's a lot more sources than I think most content creators are providing. All right, enough of this. Let me know what you think in the comments down below.